Welcome, bulls, bears, friends, middle-class dads, and loyal subscribers. We did it. The bears are dead. They are going extinct by the day, and they say the final stage of grief is acceptance. And this is what acceptance looks like. So to all the bulls, aka subscribers, thank you. But our job is not done. Keep buying the dip. And to all of the bears, if you do exactly what I say, you can maybe come out of this in one piece. Emphasis on maybe. Number 1, hug your mother. Number 2, become a channel member. Number 3, pay your margin. Then go buy some ticker QQQ and wait. Now let's get to the analysis. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell, hit that like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and another green day, capping off what has been a stellar week. Absolutely fantastic week. We saw again outperformance in the broad market, but not so much the bigger names. Some did work, others didn't. Nvidia was flat on the day, but the broader semiconductor market was actually very green. This was in part a bit of a bounce back simply because they were pretty red yesterday. Infrastructure was very green except Adobe. This did not hinder the overall infrastructure sector. But then you look at stuff like Apple, Meta, Amazon, they were flat to down. Stuff like Google and Microsoft, they were slightly up, but the broader market did gain, and it was another day where we had every sector in the green. The best performing sector, utilities, followed by industrials, comm services as well, and communications being the third best performing sector. When Meta underperformed, the broad market shows the strength in Google and that sector as a whole. And broadly, it was a strong day in the market, but none more strong than small caps. While yes, I did show you large caps did do very, very well. You take these gains any day of the week. We actually saw small caps put in the most work, particularly from the value segment. But at this point right here, when you're getting 1.62%, 1.94, 2.16% in a single day, it's inconsequential. The broad small cap market rallied, followed by the mid caps and then the large caps. And the market today was literally telling you that rate cuts are coming. Looking at the majors, we saw the IWM up 2.5% for the day. Very strong rally. It gapped up and just made higher highs, higher lows, capping off a strong week. The RSP was up 0.99% and the Nasdaq and S&P 500 were up half a percentage point. However, for the entire week, the best performing index was the Nasdaq 100, up 5.95%. This was after we got inline CPI, PPI data, and then once we actually brushed off a lot of the volatility we got here after the CPI news, stocks continued to make higher highs, higher lows, leading up into Fed cuts next week. And globally too, it was a very green day. And in the context of the market getting ready for rate cuts next week, we saw commodities outperform today like equity markets have for this week. Gold was up 0.84%, silver up 2.84%, crude had a mild gain, Bitcoin up 3.1% respectively. The dollar was largely flat here today, and bonds actually continued to fall after they put on quite a bit of a show, rallying into the stronger than expected economic data CPI, PPI we got at the start of this week. And you can see across the board, equities were very, very green. The S&P 500, the Nasdaq, small caps really taking the cake here today. But regardless of where you were positioned, you probably did very, very well. Some of the major indices that we look at on a day-to-day basis and that I've recommended on an ETF basis, stuff like the CAF index was up 3.17% today. A strong rally off the lows, an equal low right here. And what we want to see is continued strength and movement to the upside here in this index. Looking at stuff like MOAT, M-O-A-T, sort of like a mid-cap undervalued high quality index, trading near at all-time highs. I really do like this ETF. So if you're looking to get some exposure leading up into rate cuts, look at something like CAF, a small cap quality index, or a small cap cash cow index. Look at something like MOAT, companies with a wide moat trading below their intrinsic fair value. This ETF has outperformed the S&P 500 over the last 5, 10, and 15 years. But diving into the major indices, we see some very glaring things, let's actually just go to the US 500. This is the weekly chart of the S&P 500. And what a change a bullish week can do. Everything was looking really grim at this point. That was like a weekly bearish engulfing candle. Things looking far more upbeat now for the S&P 500. Pretty much a stone's throw away from all-time highs in the S&P 500. And we can see that we paired almost all of last week's losses. We didn't quite make a higher high here in the US 500. We did in the SPX though, ever so slightly on a wick basis, but inconsequential really. You really just want to look at the trend this week, and the trend was up leading into rate cuts, and bears are going to have to put in a lot of work to get us below these levels. And what bears really need to do is break this level right here. They couldn't last week, so this is starting to look like a higher low, and that's the trend we've been following for the better part of the last year. A low right there, a higher low, higher low, higher low, and now this is also looking like a higher low. We haven't quite made that new all-time high yet, but I think we probably go ahead and get that into next week's FOMC, make that all-time high, and then maybe sell the news, find a bottom, and then continue the September volatility into the end of September. That's sort of what I'm thinking with the S&P 500. If we want to look at everything on a technical level, I think this is probably the level, you know, this 5380 level, this 5400 level where we actually put in last week's lows. That's the level on a weekly basis that bears need to go ahead and take for any more bearish outcomes to occur. From here, we can then go ahead and tackle this lows, and that's when things get ugly. But that's not what we're seeing right now. At the moment, the bulls are clearly in the driver's seat. Even after the bears tried their hardest last week to take us lower, they simply couldn't push below the 5400 area. Now this is looking very, very constructive, and in hindsight, a great dip buying opportunity. And then diving into the daily chart, you can see this 5379 level, which is the weekly support zone, actually coincides with the gamma flip charts. Not one-to-one even, but you can see 5450 and the low right here. So this is the weekly support zone. This is the put support zone. So this right here is a very, very critical level that bears will probably need to break if we do want to see some major downside. And that to me leaves a lot of room for the bulls to actually pick up the slack into next week, or if we do sell the news on the FOMC event. So the bulls are clearly in the driver's seat, if you ask me. Now, the gamma flip chart has not changed from yesterday. It's still at 5550. It will change next week for sure, but we are in positive gamma, and I think we just look to the core resistance now. When we are closer to the core resistance than we are to the gamma flip zone, about 78% of the time we actually go ahead and hit that core resistance area, especially when we are in positive gamma and when we've had such a rally like we had for this year so far. Next week, the targets are very, very simple. This high right here, all-time highs, we go ahead and achieve that. Then once we get the FOMC, we can then look to our next level. So into Wednesday, Monday, Tuesday, into Wednesday, I think we just target these highs right here, 5640 and then 5675 new all-time highs in the S&P 500. And then after that, we'll look to where the gamma flip zone moves, where the put support moves, where the core resistance moves, and then readjust our targets accordingly. And guys, year to date, things looking very, very constructive on a percentage return basis. The S&P 500 up 17.63%, a stellar year with improving breadth. The S&P 500 not at all-time highs, the advanced decline line at all-time highs. And we're also starting to see some very constructive action in stuff like the Nasdaq 100. If we pull up the weekly chart, right, you can see that we actually went and broke last week's high, or where we opened last week, and that just opens up these higher levels in the Nasdaq as well as all-time highs. Again, there is going to be volatility next week, but we are in positive gamma and things looking very, very constructive for something like the Nasdaq. Look at this chart in the last year, literally like from bottom left to the top right, just higher highs, higher lows, and we're just getting some seasonal volatility right here. Everybody was freaking out when we got this, but to me, normal volatility, I said by the dip. There will come a time when we will get short, but that is not right now. And you just want to take advantage of this, because we're going to be going higher into the rest of the year, into the first quarter of 2025. The IWM also looking really constructive. This is the weekly chart. We didn't go ahead and break last week's high, but we did have a blockbuster rally this week. And when you actually zoom out on the IWM, this is the weekly chart, right? you can see we had this correction in time right here. Okay, then we put in a low at this point, and since then we've made higher highs all the way up to where we are right now, and that's another higher high that literally opens up these levels right here for us to go and retake to 52-week highs, and that opens up all-time highs at like the 248 level. I'm very constructive on small caps, but more small cap quality and mid caps as well than I am on the Russell 2000. I think there's too many non-earners in the Russell 2000. But guys, for next week in the S&P 500, let's look to these all-time high levels, right? These highs right here, these monthly highs, as well as these all-time high levels. And then from there, once we get the new data, we can see where the market actually readjusts itself, and then take on all of next week's data as well as the FOMC data, and then form a plan from there into the rest of September, looking at seasonal. So next week is going to be a very important week because it's going to inform us as to what happens for the rest of September as well as October. And then once we get this FOMC out the way, we can then start looking at what election volatility is going to look like. So subscribe, because we are in a very treacherous market. We've navigated that market very well on this channel by buying dips at strategic locations and bringing a sense of calm to everyday viewers of this channel. So guys, please subscribe, because we've generated a lot of alpha this year. We've stayed bullish regardless of the volatility. We've bought dips and it's paying out in spades, and will continue to pay out in spades. This was last week's weekend poll. Very interesting. I just wanted to bring this back to your attention just to show that sometimes it pays to be a contrarian. The Nasdaq 100 was the best performing index this week. 59% of individuals were bearish on this index into the start of this week. And what do you know? This was the best performing index in the market, outperforming the Russell 2000 and the S&P 500 respectively. But diving into the market as a whole, this is S&P 500 performance after we've had a 5% summer. Very, very interesting. So not an election year, just the broad market in general. We have 23 different occurrences. We actually had a 7.03% return in the summer for the S&P 500 year in 2024. And the results speak for themselves. What we normally see after a bullish summer is September and October tend to be quite volatile. We get a flat September, pretty volatile October, down 1.96% average return, 6 wins, 17 losses. So this period right here tends to be quite volatile. Then we actually pair all of those gains in November and December with a full period return of 2.78%. And this just tells us that the next 4 to 8 weeks, we are in a volatile period. Even though we've had quite a stellar week, we don't want to get complacent, because we are in a very volatile period of the year, and momentum brings momentum to the upside and downside, and even more so in an election year. This is 2024 year to date, and the average presidential election year, this dark blue line, you could see that we get quite a lot of volatility leading up into election day, but then after election day we pair all of those losses, all of that volatility, and move higher. This is where we are right now. Just like the data I showed you previously, do expect quite a lot of volatility and then a rally after election day. And this data right here further confirms that. If you think the VIX has peaked for the election period, it may have, because we actually saw a 63 VIX, which is crazy. But historically, the highest probability informs us that the VIX actually peaks in October of an election year, with August having the second most probable peaks. And when the VIX peaks in October, the S&P 500 typically bottoms in August. This is what this data tells us. So we are in a volatile period where we do want to buy the dip, because outsized returns do happen after the election cycle. But what does this actually translate into S&P 500 returns for the end of the year? Well, we got baseline forecasts from Goldman Sachs right here, and they got 3 different forecasts. Now their baseline is a 5,600 S&P 500 into the end of the year. They see that EPS will rise by 8% and the PE to finish at 20.4 times. That's their baseline, and that assumes the market probably just keeps chugging a little bit higher than where we are right now, and we don't go ahead and hit those all-time highs. They see a 5,900 catch up trade. This is where the broader market catches up to the mega cap names, and that will end the S&P 500 at new all-time highs at 5,500. They see a mega cap exceptionalism trade where the S&P 500 finishes off at 6,300, and I'm assuming that means the broader market rallies, but the mega caps rally even further, and they actually see their recession risk a catch down trade. This is where the mega caps trade down to the valuation of the broader market, and they see the S&P 500 at 4,800, but that's assuming we get a recession, and I don't think that is the case, especially going into a rate cutting cycle where Goldman Sachs expect 4 cuts in 2025, 3 cuts in 2024, and a terminal rate of 3.25 to 3.5%. And diving into some macro, this is BOFA's consumer dashboard, and we're just going to go through it because the consumer dashboard looking rather constructive. Now, looking at the employment situation, the unemployment rate sitting at 4.2%. We've actually increased 40 basis points in the last year, but saw a decrease of 10 basis points last month. Initial jobless claims continue to actually track lower than what they were a year ago. Continuing claims slightly higher, but the month-over-month change down. And non-farm payrolls year-over-year higher than what they were last year. That is a positive. Looking at income, average hourly earnings was actually down. We actually want that. That's a positive because it helped inflation come down. That's the whole point of rate cuts. Although personal income actually increased 450 basis points and new bankruptcy cases did increase, however, still well below the historical average. Looking at spending and lending, retail and food service sales continue to outperform. That's why these restaurant stocks, excluding certain names, have done so well. Look at stuff like Kava and Chipotle. Looking at consumer confidence, we saw a decrease from a year ago, but we've seen a huge increase in the last month, and then revolving credit balances up 6.2% year over year. The average 30-year mortgage sits at 6.76%. And guys, all of this informs us, as well as what I said yesterday, that the market is not in a recession. We're just seeing normalization and softening after those rate hikes, and we are going into a cutting cycle literally starting next week. On Wednesday, we could get our first 25 basis point of a cut from the Fed. Now, this is some very interesting data from the Wall Street Journal, and it's just a deep dive into the average American wallet, and I thought it'd be a great way just to gauge the overall health of the consumer. Now, this is change in income since 2019, and you can see that incomes have grown 23% from 2019, with the average pay being $1,151 per week. Just to put that into Australian figures, that's about 1,600 Australian dollars per week. The average American has $74 of cash in their wallet. Looking at the median checking and savings balance, this is concerning in my opinion. The average bank account only has $3,091, up 14% from 2019. This is checking and savings. I don't know about you guys, but I have that amount of money in my checking account alone. My savings account is way bigger. So I don't know if this actually includes HYSAs or term deposits or money market funds. I don't know what checking and savings include, but this seems really low. And if it is, that is scary. Is this even worth a month of expenses if you have 2 kids or you have a family of 4? Is that a month? That's barely a month's worth of expenses if you include rent, insurance, everything that works. That just seems very low to me in my personal opinion. Credit card debt as a share of disposable income is right now sitting at about the 5%, maybe 5.2% mark, with the average credit card debt being $6,200, and the average American has 2.7 credit cards in their wallet. But $6,200 in credit card debt, guys, get rid of all your high interest debt. 21, 22, 23% interest on debt. You don't need to be servicing that. Changes in prices since 2019. This is maintenance and repairs as well as insurance. In the 5 years since 2019, we've seen insurance premiums and maintenance and repairs premiums increase 40 to 50% for these two components. The average annual auto insurance is $1,715. The average monthly car payment is $737. Guys, that is a lot of money. Don't go out buying a $40,000 car. Pay your car in cash and put this money into your home equity, put this money into your stock portfolio, or just save it in a bank account that's paying 4 or 5%. There's no need to pay $700 a month on a car, guys. That's financial advice. Change in rent prices since 2019, an increase in 30% since 2019. I believe that's a 7% compounded annual growth rate in rent. Ridiculous. And the average home equity has about $325,000. The average home insurance premium is is $1,765, which is crazy because the average auto insurance premium is $1,715. The average home insurance is $1,765. That's very close to $3,500 in just insurance premiums that you have to pay. If someone's on a $40,000 wage, right, which is a pretty low wage, but if they're on 40,000 bucks, that's about 8 or 7% of their wage gone just in insurance. And the average mortgage payment is $1,520, up 25% from 2019. And diving into earnings, guys, for next week, we have a very light week. Q3 earnings is officially coming to an end. The start of the third quarter earnings season is in just a couple of weeks, but we have a couple of notable names. General Mills on Wednesday before the open, FedEx after the close, FactSet here, as well as Lennar, they're a home builder. That's really it. A very light week. However, a big focus is going to be on the data. Even though we kind of know what to expect with the FOMC here on Wednesday, it's still going to be a volatile week because now we're going to get the rate cut. What do the other FOMC events look like? 25 or 50, and that's going to be an ongoing discussion through the rest of the year for the rest of these FOMC events. Is it going to be a 25 cut or a 50 cut? That's on Wednesday. On Monday, we have the Empire State Manufacturing Survey. Then we have the final data point before the FOMC, the retail sales numbers. We're going to talk about expectations on that in the weekend video. I'm going to release a weekend video, so subscribe so you don't miss the weekend video. Then we also have business inventories, home builder confidence index. Then on Wednesday, we get housing starts, building permits early in the morning. 2 p.m. is the FOMC. Then on Thursday, we get the stock standard, leading indicators, home sales, initial jobless claims. So there's a lot of data that's going to move certain sectors, and we really have to pay attention as to what future rate cuts are going to look like, and also that 25 basis cut on Wednesday. I think Wednesday is going to be a little bit of the sell of the news event, especially with the rally we had. But next week, FOMC, it's time to enter this rate cutting cycle. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.